have been using whole life insurance policies as saving vehicles for over 200 years. This isn't a new concept.
200 years?
Yeah, the Rockefellers actually used this model. This is how they've managed to maintain their wealth since the first Rockefeller. So Walt Disney used this to start the theme parks. Ray Kroc used it to start McDonald's. Whole life insurance, it's not an investment because the term investment implies that there's speculation and chance of risk. There's no chance of loss in these policies. You will never lose money in them. Singular dollar that you have saved into your whole life policy is growing. Meanwhile, a carbon copy of that dollar is over here deployed into a higher yielding real estate investment. That's what makes it so awesome. A single dollar is doing two different jobs for you, and you're using the cash value from here. Pay down that loan. That asset's going to continue to produce cash flow for you.
Welcome back to Invest in Rome. I'm your host, Dear No. Today's guest, Adrian Rae, is educating others on the infinite banking concept and teaching people how to use whole life insurance to build liquidity, fund deals, and create wealth. Hi, Adrian. Welcome to the show.
Hi, dear. Thanks for having me. It's great to be here.
I love your glasses. We're both wearing fun glasses.
Yeah, that's great too.
It was great. We were in Tulum together at the Summer's Capital Retreat. It was an awesome time, but I'm glad that we could reconnect and shoot our podcast episode.
Yes, finally.
All right, so let's get into it. We're talking about insurance. My first thought about insurance is it's totally boring.
Yeah.
It is not the sexiest topic to talk about.
No.
But this is what the wealthy people are doing. And people love it because this is how they are building wealth. Why is it so popular? If you can go into explain, like, what is infinite banking? What is that concept, like, in very simple terms for our listeners?
It's having a moment right now online. A lot of people are talking about it. If you go Google infinite banking, it's going to pop up everywhere, all over YouTube. There are gurus left and right slinging this term. But the reality is people have been using whole life policies because that's the vehicle. Infinite banking is the process. They have been using whole life insurance policies as saving vehicles for ever, over 200 years. This isn't a new concept. It's new more
200 years.
forever. Yeah, a very long time. Yeah, the Rockefellers actually used this model, and there's a whole book on it that this is how they've managed to maintain their wealth throughout all the generations since the first Rockefeller.
It's like the book with the Rockefellers and the Vanderbilts, right? And the Vanderbilts lost their wealth while the Rockefellers continue to be wealthy.
Yes, absolutely.
Because of, and this is one of the tools they use. Yes. Okay.
Yeah. And they're not the only ones. Walt Disney used this model to start the theme parks. Ray Kroc used it to start McDonald's. Because there are a lot of endeavors and risks that we might want to take, whether we're starting a business, we have a new idea, new investment opportunities that come up. We believe in it. We see the potential. Maybe the bank doesn't, or the bank just has really strict lending terms and you can't get away from it. It's like, but you want to really embark on something. This is having this set up and having this tool in your back pocket is what gives you those options. So thanks to this concept, we now have Disney World and McDonald's, and the Rockefellers live on, and many, many other opportunities that have been funded in this way. It's not the sexiest thing ever, but reliability, protection against loss, and volatility buffers, all of these things are super sexy. Oh, death benefits. I can't say that's sexy because that's super sad, but it is great. But it is really like what peace of mind that can give you in your living years. And then just knowing that once you pass, your family doesn't need to worry about funeral costs or anything like that. So because it is a life insurance product, there is a death benefit associated with it. So super important for taking care of your loved ones. There's also a lot of living benefits that come along with these policies. What is the actual like process of this? What does it look like? Well, within these whole life policies, you are allowed to do a couple things. You are allowed to leverage the cash value within it. So this is what Walt Disney did when he started Disney World. He was denied loans, leveraged his whole life policy. What that means is that the insurance company is using your cash value in your account as collateral. Your death benefit, actually, it is collateral against the loan. So you simply go to them and say, hey, I want to take out a loan. They say, okay, what's your name and where should it go? That's the only question they ask you. There are no, tax documents, income statements, 20 questions in a long process. None of that. It's awesome for speed as well. You can borrow against the cash value in your policy, go deploy it into a higher yield asset, that a more speculative investment where there is potential for high growth. When you start making that cash flow back, pay back the loan that the insurance company gave you. The reason why this loan may be favorable over others is, one, it's a relatively low rate. It's not tied to the Fed's rate. This is the insurance company stating their own rate. It's unstructured, meaning you could pay it back whenever you feel like it. And if you die before you pay it back, no problem. They'll take it out of your death benefit.
What happens if you don't pay it back at all, and you're still living though? Is there any penalty?
There's no penalty, but there is interest, and the interest will continue to accrue until you pay it back. There are a lot of ways, not necessarily around that, but the policy does produce dividends, and as it does produce cash flow, you just have to pay it back. So these policies are actually very flexible in how they can be designed. And, it's called whole life because you're covered for your whole life, but that doesn't necessarily mean that you have to be forking out the money every single month to pay it for the rest of your life. So it really depends on how the policy is structured. And that's why it's really important to work with somebody who knows how to structure a whole life policy for this use. Not all policies are structured the same, and not all producers are going to know how to craft the policy to best meet your goals. So there's a lot of nuances there, but finding the right partner is really important.
If I were to walk in or go to my insurance broker, how do I ask for that, for this specific type?
Yeah, it does require a couple of things. So one, you need it to build cash value. That means you need a paid up additions rider attached to the policy. You're going to want it with a mutually owned insurance company. That means that the policyholders are owners. There aren't shareholders that are calling the shots. So that means that dividends get paid back to you. And that's what really supercharges the growth of the policy. So mutually owned, dividend paying, paid up additions, these are really important things. I only work with a select few that have track record. They've been around for over 200 years, and they've paid out dividends through the Great Depression, the Great Recession, all of these major financial crises. These insurance companies have continued to pay out their dividends. Dividends aren't guaranteed. They can't put it in the guaranteed column on the illustration that you'll receive, but they've had a great track record of actually paying them out. So that's really important. I would also say, make sure that the agent that you go to knows how to structure these, that they are familiar with the process. That's definitely a really important factor as well, because even though they're adding on a paid up additions rider, there is an allocation spread between your cost of insurance and how much is going towards the paid up additions. So you want to make sure that that's balanced appropriately.
When would you say someone should do this whole life insurance strategy? Should it be part of their normal portfolio, or is it they need to get a certain amount of wealth built before they start investing into whole life insurance?
First of all, whole life insurance it's not an investment, because the term investment implies that there's speculation and chance of risk. There's no chance of loss in these policies. You will never lose money in them. It's based on contract law. They're going to pay your death benefit. Your money is not going to be, it's not at risk. So for that reason, it's not an investment. It's a savings vehicle and a risk mitigation tool. So where this sits in somebody's financial picture, think about your investment, your financial situation as a pyramid. At the top are the most speculative investments that you make up here. And at the very bottom, this is your financial foundation. This is where your insurance policy sits, your whole life policy sits. This is where your cash, your insurance policy, all the things that don't lose money live here. So it's at the base. This is the foundation of everything. So if you're somebody who already has a good savings record, track record, if you are diligently saving for retirement, you want to be able to create more opportunities for leverage. It is a bit of a lifestyle, because you've got to kind of rethink how the money systems work, because now you're taking your money off the IRS's radar. When these are structured correctly, you're using post-tax dollars and you're putting them into this policy and protecting them from future taxation. There is a bit of a mindset shift, because if you forget why you're pursuing this, you'll feel like you're paying a lot of money into something, but you're not using it correctly. And you may let it expire, or you'd stop paying your premiums, and then that was all for nothing. It's definitely somebody who has their mind open to wanting to take control of their own financial situation and create opportunities for leverage, protect their human life value. So that's your earning potential over the course of your lifetime. The death benefit protects you, protects your family from losing that potential growth, meaning when you pass, they get a death benefit. So that's important. If you are, for anybody, it's important. I don't have a family at this point. I don't have a spouse, but I have life insurance. And that is because I want my immediate family to be protected, to have all of my assets covered, funeral costs covered. And I want to be able to leverage this policy for my own investments while I am living.
How can someone combine this strategy using whole life insurance, pulling out money, loan lending, and real estate investing?
Yeah, it's one of my favorite tools for real estate investors because there is such a high yield against real estate. So what happens is you've allocated a set amount of money to go into your policy every month or every year or semi-annually, whatever it may be. And you're building cash value. Your cash value is probably growing anywhere from 4.5 to 6%, somewhere in that range. So you've got a nice, consistent, solid growth compounding within your policy. When you take out a loan from the insurance company, they're giving you a carbon copy of those dollars. So you're not interrupting the compound interest that's happening here. That dollar is continuing to grow. You're going to take out a loan from the insurance company. They'll be charging you, let's say 5% on that loan. You've got $100,000 growing here at 5.5%, 5%, whatever it may be. You've taken a loan for like $50,000 for a passive investment. Carbon copy that dollar, you go deploy it into a passive investment or an active real estate deal, whatever it may be. Because it's an unstructured loan, you have time to let that investment mature. So maybe you have to do some renovations. Maybe the operators that you invested in passively with have to do renovations and reduce expenses, increase the NOI so that your distributions can be realized, that you start receiving cash back from those investments. Once you start getting your cash flow back, now you can start paying down the loan. So what's happened now is that singular dollar that you invested into that you saved into your whole life policy is growing at 5.5%, 5%. Meanwhile, a carbon copy of that dollar is over here deployed into a higher yielding real estate investment. So yes, there is a cost of the loan that you took out from the insurance company, but that's like, 5% on the 50K or whatever it was. Meanwhile, the full value of your cash value is still compounding. So the full 100K in there is still compounding at whatever percentage your policy is at. And I can't say exactly what it is because it kind of depends on the company, but it is, let's just call it 5.5%. So while that's compounding at 5 and you've got a real estate asset growing at 15 potentially, you've got a 10% arbitrage there of growth. That's what makes it so awesome. A single dollar is doing 2 different jobs for you, and you're using the cash value from here, pay down that loan. That asset's going to continue to produce cash flow for you. So now, instead of taking your hard-earned money, receiving it from your job, from wherever you get that from, your income, and putting that straight into an investment or buying something that you need with it, you put it into your whole life policy, let it grow, borrow against it, put it into a higher yielding investment, take that cash flow, pay back the loan, take the continual cash flow that you're still getting from that, and now use that to fund your life. And that is the concept, no dead end dollar. Because right now, if you take money that you're earning, that you've been gifted, however you receive funds into your life, money into your life, and you swipe a credit card with a transaction and go spend that money somewhere, that money's gone. It's not within your banking system anymore, your personal banking system. So it's a dead end. That money's done nothing for you. Maybe it's bought you, I don't know, food, clothes, purse, whatever you need. But it's gone. And then investment comes with risk. It's all speculative. So some things could go south with an investment. So you've taken that dollar that you've earned, you put it directly into the investment. There's really no buffer there to say that, to protect you against any losses that may occur. So first, deploying that earned money into a whole life policy protects you from loss. It takes the dollar off the IRS's tax radar because you're not paying tax on the loan that you get.
Right.
Yes, you got to pay tax on your gains that from the real estate deal or whatever it is that, whatever that investment was, but you're still growing uninterrupted compound interest within this policy with that initial dollar that you deposited, that you put into the whole life policy. So I hope that makes sense, because that is the actual massive power of this policy. When you use a whole life policy for this infinite banking concept, this is where the infinite part comes in. It's still growing uninterrupted compound. Meanwhile, you've got a carbon copy of that dollar deployed into another growth vehicle.
That's super exciting. And that's so smart. I don't think a
exciting.
lot of people will have, like, yeah, that is exciting. It's
For
like, why
nerds
wouldn't
like
you
us?
do this?
Yes.
I know. Like, why wouldn't you do that? That makes
Yeah.
total sense.
And that's kind of the battle that I face often, is like, people say like, no, that's a scam. It's like, wait a second. I just don't think you understand what's happening here. And I think a lot of people make big claims on the internet, and it sounds too good to be true. And for a while there, it was too good to be true, which is why Congress did tighten up some of the restrictions. So there's like a 7-pay law, a rule. There are certain restrictions or limitations that Congress has put in place because people were using these policies as tax havens. Essentially, if it's not structured correctly, it can become a modified endowment contract. So that's something else to look for when you're talking to your insurance producer. And if they know what they're doing, they'll make sure, because the whole point of it is to not get taxed on the gains. So we wouldn't want that. So there's what's called a MEC limit, the modified endowment contract limit. And you basically create the policy so that it doesn't cross that limit.
Do you mean like the contributions from someone should not exceed the MAC limit? Is that what that means? Or not the contributions, but like, the premium payments.
So the MEC limit is determined by the 7-pay test, which is the maximum amount of premium that can be paid into the policy during the first 7 years. So you want to keep that under threshold so that it doesn't become a modified endowment contract, which creates a taxable event.
Awesome. So on top of that, they're also getting death benefit. If they die, then their heirs get some insurance.
Yeah, your beneficiaries then get a payout when you pass. Can it go without explaining why that's important? Sure, but I think it is worth touching on, because a lot of times when people create these policies, they get very caught up in the whole concept of the infinite banking concept. And they do forget that the death benefit is a highly important part. Let's say you've got a set amount of cash allocated each month. Like, I'm saving $1,000 a month in my $1,200, whatever it is, in my savings account. But it's not doing anything for me, of course, because it's a crappy savings account. And you decide that you want to pursue the infinite banking concept. So you're looking at a whole life policy. A huge part of this is the death benefit. That $1,000 that you have earmarked for monthly payments into the whole life policy, a portion of that has to go towards a death benefit because it's an insurance policy. The rest of it is going to contribute towards the paid up additions. What we aim to do is make the paid up additions as juicy as possible. Of course, so that means we have to reduce the death benefit so that your cost of insurance is super low. But we don't want to be inconsiderate here in that the death benefit is highly important. So if we reduce that too low, your assets aren't covered. You're not protecting your family from what they truly need. So we do have to take a holistic look at what your cost of living is and what your family would need to be covered, what assets you have that would need to be taken care of, what other life insurance policies you have, and then really determine what that balance should be between having you covered with the death benefit but keeping it as tight as possible with the paid up additions. And sometimes what we'll do, and what is necessary, is adding convertible term policy on top of that so that there is additional death benefit to have you covered. It's an important component. And a lot of people write it off sometimes because they really just want the paid up additions and they want to build the cash value. And that's all well and good. Yeah, death benefit's super important. And there's a sense of ease that I remember I felt when I got my policy set up. I wasn't going to recklessly go, skydiving or do these activities that I wouldn't normally do. But it just felt really nice knowing that I'm acquiring this real estate. My family doesn't know how to operate. They're not real estate investors. I don't come from that lineage, and they may not want to operate it. They may just want to pay it off, whatever. They have choices. And they also have the option to take work off and just grieve. They have options to throw a big party when I'm dead because I want people to celebrate. I don't want them to be sad, whatever. So whatever you want to see happen, it can now, because you'll be able to afford your family the opportunity to take care of those things. And that is power when you're living every day, knowing that you will be leaving a legacy of some sort, even if it's just protecting the cost of the funeral and a couple of your assets. It's really important.
Can I use this strategy to pass down money to my kids tax free? Can I like assign it to them somehow?
Yeah. Yeah. They essentially become your beneficiaries. So first degree familiar tie would be the beneficiaries that you can claim on your policy. So absolutely.
When they get dispersed the money, would they have to pay taxes?
No, not up to a certain point, but every state has different rules.
Yeah, this is definitely a strategy I think everybody should have in their portfolio, especially if you have a family and you have kids. I'm definitely going to be looking at it for sure. I'll probably have to ask you later.
Yeah. And in regards to kids, you can start these policies when they're super young, super young. This is either good to supplement. I don't have any kids, but I know they have some college funding funds
Yeah.
that you pay into. So in lieu of those, or in addition to those, this is a really great tool that you can pay into throughout their whole lives. The younger and healthier you are, the more advantageous the policy can be. You're locking in your health and your age at that point. The premiums don't change. Unlike term, you have that price up to a certain age and then everything resets and you have to get covered again. So for whole life, this is the price that you pay for your whole life, no matter what happens in the future. So for young children, it's a really powerful way to set them up with a college fund, a wedding fund, whatever expense. There are so many expenses that come up with kids. So it's an amazing savings vehicle for kids. And then you could gift it to them and give them the policy later on in life. Teach them about it. Teach them how it works. Teach them about leverage, what that means, and where the opportunities are for them to use this policy as they grow their financial picture. So exposing it to them is a really great way to teach them about financial literacy and how to manage money and what leverage means.
Could I buy my kids, like have the policy in their name?
That's exactly what I mean. Like
how
you do
have their name.
The different components of it. There's a life that's insured, there's a policy holder, and there's a beneficiary. So the life that's insured is their life. So it is in their name.
As a parent, that's definitely a good thing to think about. And then they can be their own future bank when they're grown up and they're 18, and they'll have the funds already available to them, so they can use that money to buy a car or college or
yeah. And this was the success of the Rockefeller family. The Rockefellers actually used this process to teach generation after generation about financial literacy. So often wealthy families, their kids just get handed lump sums of money and they blow it. So using this as a tool of restraint, even to show them the wealth that they could have access to, but here's how to responsibly use it, is really powerful as a means of teaching financial literacy as well.
Okay, so if you had to pick, would you rather put money in the whole life insurance or invest in the stock market, or use your infinite banking whole life insurance and take a loan on that and then do your investments?
That third choice would be my way of going about it. I personally probably wouldn't, if you wanted to borrow against it and go pick stocks. I mean, when it comes to the stock market, I prefer alternatives, so I don't participate in the stock market. But if I did, I would stick with a fund. That wouldn't likely produce the returns to create that arbitrage that I'm looking for. Certainly you could, but I would rather take it and put it into a real estate investment. That's my cup of tea. That's what I like. I like the growth potential in real estate, both active and passive. I like having a blend of both. That's what I do.
Okay, so let's take a step back. How did you get into whole life insurance? Like, where did you hear about it?
Yeah, I was at some random meetup and somebody mentioned that this person that they know was using a life insurance policy to borrow against it in order to do this. I was like, what? That sounds crazy. I don't understand what you're talking about. But I was very intrigued. And then I heard about it again on another podcast. And I was, again, very intrigued. So then I started doing some research and I started scratching the surface and I realized, okay, this sounds super interesting, but it's based on my current age and health status because it's a life insurance policy. So you have to qualify. Anybody listening, don't write yourselves off. Let the insurance company decide because there's a spectrum and there are different classifications. So the first thing that I did was I got a convertible term policy because I wanted to lock in my health at that age. A convertible term means that it's I can convert it in 10 years into a whole life policy, but it's still going to honor the age and health status of where I was back then. And that's super powerful because if I later were to be diagnosed with cancer or hit by a bus, whatever it may be, an event that would otherwise disqualify me, I didn't want to be out of the game using this financial tool. This sounded way too good to be true, but I wanted to learn more about it and I wanted to have an opportunity to use it. So first thing I did was I got the convertible term while I continued to learn. So I locked that in. That's like $18 a month. I was like, no harm, no foul there. Great. I've got $1 million policy to myself while I dive in and learn about this. And so then I started doing a lot of research. The Nelson Nash Foundation, he's the one who coined the term, the infinite banking concept. There's a great book out that he wrote about the infinite banking concept. That was probably where I started, dug around the internet, learned about it. I was like, wow, this is a super, super cool opportunity. I want to tell everybody about this. I want to be able to help people use this tool. At the time, I was an agent for commercial artists. So I was helping them make good money. I was helping a lot of money come into their financial picture. But what happened with it after that, no say, like, I'm not their financial advisor. Money would come in and then they would spend it as they do. But what I would hear a lot of them say through COVID and other hiccups in the marketing, advertising industry, marketing budgets getting cut, they'd say, I want passive income. They weren't making money when they weren't on set. So if they weren't out there creating work, they weren't getting paid. And when the industry dried up from time to time, as it often did, they didn't have money coming in. So passive income, a form of income where they didn't have to be present, became a really popular topic of conversation. But because they are focused on their careers, it does take a lot of energy to underwrite deals and understand what are great investment opportunities. Adding this component, when I learned about it, I was like, this is huge. This is a way that my artists that I loved so much and that I wanted to support, that they could set this up and this could be the foundation of their wealth and where it's protected, where there's no chance of loss. From there, they can leverage it to put it into investments, more speculative opportunities. I had a network of operators and in the real estate space where I could provide them, I could point them to plenty of passive real estate investment opportunities. But of course, there's a chance of loss there. So when I learned about using whole life, I was like, wow, that's an incredible buffer to protect your wealth, have it grow, compounding, uninterrupted. What an amazing first move with your money. And then move it into an investment. So once I kind of put those pieces together, I was super passionate about it. I knew that this is amazing and I wanted to continue to pursue it. So that's how I got into it.
That's super awesome. It just makes sense. It's so smart as far as for investors, right? Because you want to make the most of what your hard-earned money is doing. And so if you can double down on that, why wouldn't you?
And fast forward to retirement, whenever that ends up becoming a reality for you. Because the freelance artists that I worked with, it's not always 65 and a half, that's not a retirement age for everybody. That's just when you can now touch your retirement account without being penalized. And you've got a couple of years there before you're forced to withdraw from it. But then as soon as you start touching it, now you got to pay taxes on it. For a lot of people, retirement comes at different points in life. If you are only relying on the money that's been growing inside of a stock account, maybe as you get older, your allocation switches, bonds, whatever it may be. But as you start withdrawing, you never know what the market's going to be doing at that time. So if you decide you're going to retire at a certain age and the market happens to be down and you need to withdraw from that account, you've really stymied your potential for having cash long-term in your life. We're going to live a long time. The medical system is very advanced and they will put all sorts of tubes and stents and things in us, pacers, whatever it is that keeps us alive for way longer than we may anticipate. So you need your money to last. And whenever the market is down, every time you pull against it, you are impacting the potential growth of that. Another benefit of what these policies is using it as a volatility buffer. So yes, you can have your 401ks, your HeyRaise, whatever, your traditional retirement process. But when the market is down, don't pull from it. Keep that money there. Go borrow against your insurance policy because now you've got a volatility buffer. You can borrow against it, use that money to fund your life, in retirement, wait for the market to recover. When it bounces back, now you can replace those funds within your policy or not. Either way, it depends on where you're at in life and what your financial picture looks like. But now you can now you could withdraw from your retirement account as you would have traditionally, and you haven't hurt the growth of that account. So it's an amazing tool as a volatility buffer as well.
Yeah, I'm excited to get into it more, and I'll have to reach out to you after this to talk about it and how to set myself up for it. But
I'd be happy.
Yeah, this is cool. This is awesome. And so now you are doing some traveling after this, and you're off to, can you remind me where you're going?
First Berlin, because it's an awesome city and I'm due for a trip to Berlin. And then after that, Valencia, Spain. I think I want to stay there for a little while. My whole business is remote now. So in addition to the whole life, which is like my major passion project, I am an agent, a licensed agent, but I do work with my mentors to actually fulfill a lot of these policies because the other half of my life is my marketing agency. So a lot of energy goes into that as well. And so I've set up my marketing agency to be pretty much we've got a global team. We're all over the world. We do service clients in the US only, but working all over the world allows me to cross time zones and communicate with my team whenever we need to. So I'm really excited to go pursue lifestyles in other countries, see what that looks like, and just be a student of the world and continue to learn and grow and find a lot of opportunities for self-development and improvement and new challenges, a lot of new challenges.
I love that. See, that's what passive income can do for you when it gives you flexibility, and now you're off traveling and now you're off working remotely. That's so awesome.
Yeah, I really feel like real estate and whole life has given me options. And that's really one of the most important things to me in my life is to just create paths for options. And because you don't know what life is going to serve you. But if you are narrow in your pursuit of your career, narrow in your pursuit of your finances, it must be done this one way, the one and traditional only way. Well, that way may fail you, as a lot of people are experiencing with their 401ks. These are relatively new products. For instance, like they only came about in the 80s. Pensions really fell by the wayside. And that was the responsibility. The risk was on the employers to provide an income after their commitment to their employee and vice versa. Well, that went away. And now you've put that onus on yourself within a 401k. And that is the only way for a lot of people that they are planning on funding their retirement. And they're working their whole lives just to feed that account, just to feed that. And the thought of that is so heartbreaking to me. You're taking your healthiest, most productive years of your life and just grinding away for the final quarter of your life when now your health is diminished. You don't have the energy anymore. For me, it's an old-fashioned way of looking at the timeline of your life. Instead of this like ladder stepping stone from one to the next, I want mine to be whole lots of loops and turns and twists and, who knows, a lot of excitement. But in order to pull that off, you have to have multiple streams of income so that when one gets taken away, don't worry, you've got a few others working for you over here so that you can take chances on investments when they come your way. When opportunities do present themselves, you've got a foundation of wealth that you can leverage in order to pursue that. So it gives you that opportunity. Having that whole life policy has been such an important foundational part of my financial picture, and owning real estate as well.
I think they say that you need 7 streams of passive income and you're set. So if you can make at least minimum 7 streams of passive income, then you should be good.
Yeah, that's what they say. And also, I just want to remind people that there is an in-between. You don't need to sit there and be like, oh my gosh, I'll never hit 7. I'm only at 1 or 2. I'm only at 3. I still can't do anything yet until I hit 7. No, there's still so much room for growth, development, and opportunity between streams of incomes 1 through 7. Your life isn't only going to start once you hit 7. Don't be afraid to start living in the in-between because there's a lot of growth that happens there too. So start stacking and start living. Like that's
really, I like that phrase.
Yeah, I don't have 7 streams of income myself. I'm working on it, but it doesn't mean that I can't pursue the life of my dreams.
Right.
And
Oh
also,
my God, I like that phrase. Start stalking and start living. I'm going to start
yeah,
saying that from now on.
yeah, it's a good one. A lot of people wait too long and they think they have to hit a certain point. They see people's overnight success, but we've heard a ton of times, it's not overnight, it's years in the making. And there's a lot of life that happened in between there. Just because you see yourself at the end doesn't mean you can't feel like you're benefiting and growing and evolving as a person during all of the in-betweens.
I love that. Well, this has been awesome, Adrian. This is
Yeah.
great. Where can people learn more about you or get in touch with you? And what's up next for you besides all this travel? You're traveling and working, and what do you got planned?
Man, I don't know yet. Growing the marketing agency has been a really big undertaking, and that's a huge endeavor.
Can you mention the name of your marketing agency again?
Sure, it's called HeyRaise. We're in the alternative asset space. I'm clearly a big fan of alternatives. So either acquiring them for myself, helping people set up their lives, their financial pictures in order to pursue them. That's the whole life side. And then I'm helping operators raise capital for their opportunities. So my aim in life is to help people acquire wealth off of Wall Street, kind of non-traditionally, get off that traditional path. So I feel like alternatives and whole life are not your typical way of pursuing wealth. A lot of people just talk about saving and investing in the stock market. Those are so boring to me. Slow, boring is fine.
Yes. There is so much more opportunity out there besides your,
There is. And when you really,
usual financial advisor. Yeah. There's a whole world out there of investments.
yep. And when you start learning about them, you realize there's a bit of a game to this all. You can gamify it. And that makes it a lot of fun. That doesn't mean you're reckless just because it's this fun pursuit of strategy, financial strategy, but turning it into a game makes it really exciting. It's kind of the game of life at that point. And you realize a lot of people are playing this game at a whole different level. And where you're playing is like just the starting line. Maybe that's only where you're at. And that's okay. But like starting to learn and realize, just opening up your eyes to what possibilities are out there, even though they may sound so foreign to you today. The more you read about it, the more you learn, the better the language comes to you, and you start to connect pieces. Those, energies and neurons begin to fire together, and the picture becomes a little more clear every day. That's part of the journey of playing this game of life. So going back to the agency, my goal is to help democratize access to these investment opportunities. By doing that, by helping my clients crystallize their story, their brand messaging, the story behind the deal, and then expanding their reach through different marketing channels, I'm helping them reach more people. And that's really what I want to do, is just let people know that these opportunities are out there. You can invest in them. They are safe. Not everything is a scam, but oh my gosh, do all of your own research and your own underwriting, your due diligence, ask for help. There's a ton of networks out there of people that are willing to help you understand and dissect these investment opportunities. Don't be afraid to ask questions. Everybody doesn't know what they don't know, whatever it is. We've all been there. Actually, what Nelson Nash calls it is the arrival syndrome. When somebody feels like they've already got all the information and like, oh no, I'm good. I don't need to pursue that. I already know what, you've arrived. You already know what's in front of you. It's like, well, I'm sorry, you don't. There's a lot out there, and you have to be humble, put your ego aside, and commit to learning, and then find joy in learning. A lot of people are like, ew, money, it's just not for me. But, flip that on its head. You got to tell yourself, like, this is fun. I want to learn this. And through the process, you may discover the gamification of it. And when I realized that, I was like, oh, this is a really fun strategy. The game of real estate investing, value add. This is really awesome. At the time, I was like, I don't know what any of these numbers mean, but I like the idea. So, I just kept going and just kept learning. I have a lot of fun with my marketing agency, helping operators raise capital and, connect with retail investors and then elevate their brands. But where can people reach me? LinkedIn is probably the best platform. You can actually find me there, and on Instagram, Adrian Rae. It's just my name. Type in my name and I'll pop up in your Google search bar. So
awesome. Yeah, we'll drop the link in the show notes for everybody. Thank you so much, Adrian, for your time today.
Thank you, dear. Appreciate being on the show.
Best wishes on your travels.
Thank you.
Awesome travels to Berlin and Valencia. All right. Thanks for joining today's episode of Invest in Rome. If you found value in this episode, please share it with a friend. New episodes dropping weekly. Like, follow, and subscribe. Until next time, I'm Dear No. Keep investing, keep roaming, and keep living the life you deserve.